So one of the things we like to do is we like to use Portfolio Visualizer to understand what is actually happening between different portfolios. So if we take a look at a couple of different combinations of portfolios, so we have VOO, VUG, VTSAX, VTIAX, and why don't we also throw in like a market bond situation. So portfolio one, this is my portfolio, 50-50 across VOO and VUG. My old portfolio would have been 80-20 here. And then I think a common portfolio that we would find in a Boglehead would be like 34% US stock, 33% international, and then 33% in the bond market. So if we were to, why don't we just customize the names here a little bit. So portfolio one, we'll just say Mike's. Portfolio two, we'll say old Mike. And then portfolio three, we'll call this a Boglehead. So I think we've got our things now. Let's see here. Yeah. So in looking at this, you can kind of see what's going on here. So my new sort of portfolio, which is again a 50-50 balance between VOO, which is the ETF for tracking the S&P that Vanguard offers, and then VUG, which is the growth ETF that Vanguard offers that looks at some of the cream of the crop large cap growth companies. You can see that performs the best when back tested. Let's see, since January 2011, which is probably just limited by data availability across all of the different selections we have across the portfolios. You can see that it does have a higher standard deviation than the others, meaning it's going to be more volatile, right? So your best year is around 34%. Your worst year is 25.67%, and your max drawdown, the largest drawdown we saw, was 28.47%. But if you look at the old me, I think this is where it kind of gets interesting. You can see here that I'm at, $14,000 less, and I have, roughly 2.5-3% down in the CAGR. I have a slightly lower standard deviation, but not an incredibly low standard deviation. There's not a huge departure from the more aggressive standard portfolio standard deviation. And then I think what's interesting here is that if you look at the Sharpe ratio basically is a measurement that looks at the excess returns that you get for the risk that you take on, and a higher number is typically better. And you can see here that what this is telling you is that the new portfolio, which is sort of 50-50 S&P and growth, is actually going to give you more returns for a reasonable amount of risk that you're taking on. So you can see that the max drawdown here, even on the old portfolio, which is supposed to be super stable, was 25%. And then the Boglehead, which even includes bonds, was 22%. So there's a difference of 6% in the max drawdown, which to me isn't crazy for the upside that you're getting here when compared to this portfolio. So that's kind of why I think, looking at it from sort of like a portfolio allocation standpoint, I think that's why I'm so aggressive now in looking at doing S&P, doing growth funds, because really, I think there's just too much growth to leave on the table. You can see here the blue line is just absolutely destroying everything else. So, am I a believer in the Boglehead movement? I think I am, to a certain extent. Like, I really do think that the majority of sort of the financial advice that they convey makes a ton of sense. But I do think this is where we get into some departures. I am not really that interested in bonds. As young as I am and as much time as I have to recover, I think the VOO and VUG blend is one. It's an ETF makeup, so it's going to be low expense ratios, the lowest expense ratios I can probably get for that kind of a diversification. Two, it's going to give me exposure to S&P, which is it's weathered every single financial recession we've had and bounced back. And there are people who literally just invest their entire portfolio in VOO and have done really well. The VUG part of it is obviously the risk, right? But I think there will be more years where growth does well and carries significant upside, and there will be down years. And so that's the bet I'm betting. And as you can see here, it does have a significant difference when you look at these portfolios. I think the middle range is here, which is sort of what I used to do, which is like, I want some exposure to international. I want some exposure to US. I might be slightly underweighted at international, but it's sort of like a middle road between the two. So here's what you can see when I was talking about winning years and losing years. What's interesting to me is that like the blue line is the portfolio that we're talking about with a combination of growth and S&P. And you can see like since 2011, there's, let's see, 2 years where I would have had losing years. Every other year I would have had a winning year. Even in 2015, when the other two portfolios somehow had losing years, but I had a winning year. So that's kind of the idea there behind my portfolio makeup. Just wanted to share that with you guys. Let me know in the comments what you think about the approach.